This tutorial will discuss calendar spreads, one of my favorite stock option strategies. If there is a stock you like, using calendar spreads can be far more profitable than owning the stock. Even better, you can make good money even if the stock does not go up. We will also introduce the Analyze tab on the thinkorswim trading platform. If you are serious about trading options, you will want to use this software or find something like it. I have looked far and wide, but have never found any software that comes close to what thinkorswim offers for free for their clients. This is the thinkorswim trading platform. I want to click on the Analyze tab, and I've entered cost, which is symbol for Costco, one of my favorite stocks. I would like to sell some calls that have about a month of remaining life, 29 days in these November 2s. So click on that, and the stock is selling for right now $150.56. So I want to select the 150 strike price, which is at the money, and I right click on that and I say Analyze a buy trade. I want to buy a calendar. Now I would like to go out about 6 months for the long side of my calendar spread, which would be the April series, and change this down here to April. And I see that I've got I'm buying April 16 calls and I'm selling November 2 15 calls. It's going to cost me $4.60. That's the midpoint of the spread price. I like to buy 5 of these, so I have a little skin in the game. It'll be about a little less than $2,500. So next thing we need to do is to go change the date here to the time when these November 2 calls will expire. They expire on the 13th, and so I want to see what the situation looks like the day after that. So I'm going to click on that and look at the risk profile. This graph shows how much we will make or gain on November 14th at the various stock prices where it might end up. You can see that the absolute maximum gain comes if the stock ends up right at 150 strike price of the calendar spread. And we've got a break-even range of about $5, a little less than $5 on the upside, and a little more than $5 on the downside. I set this $5 range right here because I think that's the likely range within which Costco will fluctuate in any given month. So what happens if it ends up just where it is right now? Well, we'll make $1,000 on a $2,500 investment. That's 40%. Not bad. If it goes up a couple bucks, we make, in this range here, make about $500. However, I must say that most of the time I don't buy just a single calendar spread. I think that Costco is much more likely to go up in the next 30 days than it is down. So what I'd like to do is to add simulated trades. I'll buy a second calendar spread, and I'll do it at the 155 strike. So we're going to buy a calendar here. Again, I'm going to go out to April, alongside, and it tells me this spread's going to cost $430 per spread, and I'll buy 5 of these as well. So let's see what the risk profile looks like now. Now I can see that if the stock ends up anywhere between 150 and 155, anywhere in that range, I'll make about $1,200 on a little less than $5,000 investment. Well, that's not too bad. That's like between 20 and 25% for a single month, and it can fall anywhere within that range, and I'll be making that 20 or 25%. By the way, my Costco portfolio has made 112% for the first 9 months of 2015, which means I didn't make the 20 or 25% each month, but I did enough times. And what I worry about is it falling outside of this range. Now you can see that the range doesn't extend to $5 on the downside. It can only fall about $3 before I break even on the downside with these with the 150 and the 155 spread. On the upside though, it can go from where it is now all the way up to 158 before I lose money on the upside. In the next video, I'll explain what I do if the stock fluctuates so much it gets outside of this break-even range. I like to look at the range, the break-even range, and see if I feel comfortable about the stock ending up in that range in 30 days. In this case, I feel very comfortable, and I look forward to a 20 to 25% gain if it does fall in this range right here. Let's look at an actual Terry's Tips portfolio that trades Costco. This portfolio is worth about $6,500. It started out the year at about a little over $6,000, but we had a 2-for-1 split, so everyone who invested in this portfolio at the beginning of 2015 has more than doubled their money right now. But this is what the portfolio looks like right now, October 16th as I write this on Friday. And we have down here at the bottom of the positions in this portfolio, and we have 2 calls that expire in a week from today, 5 more trading days. And the stock is currently selling at 151.62, and this is the risk profile graph here shows that if the stock stays right here where it is now, a week from now, we will make a little less than $400 on these positions. That's a little more than 5% of the portfolio value. If the stock goes up, as we expect, it'll be in this range someplace, it'll make more money. If it goes up $3, we'll make a little $600, about 10%. So in this range here, if it ends up between 151.5 and 154.5, it's going to make somewhere between 5 and 10% in a single week. You can see why I like calendar spreads. Let's look at another Terry's Tips portfolio. Again, it's an actual one in a separate account. This one's worth about $6,000 and trades options on Facebook. These are the options that we hold down here at the current time. And the stock is selling for a little over $97 a share. And this is a risk profile graph for 1 week from now. We have options expiring next Friday, 5 trading days from now. And you can see that if the stock stays just where it is right now, a little over 97, this portfolio will gain a little over $600, about 10%, a little over 10% of its value. And if the stock moves higher by $3, it'll make half that much, make about 5%. But anywhere in that range, it makes between 5 and 10% in a single week. Just another example of how great calendar spreads are. Now you may notice if you study these things that we actually started out with calendar spreads, but over time we switched the short positions to strike prices that are quite sometimes different than the long calls that we have, and it makes them diagonal spreads rather than calendar spreads. But diagonal spreads are pretty much the same as calendar spreads, except the strike prices aren't exactly the same. They're similar to the extent that the long positions have many more months of time to go, and the short positions have, in this case, only 1 week to go. And we have others expiring a week later, October 5s, November 1s expire in the November on 6th. So we have a bunch of weekly options that we sold when they had a month of remaining life. And this is one more actual Terry's Tips portfolio that trades diagonal and calendar spreads. This one trades Starbucks, and this is what the risk profile graph looks like for Starbucks for 1 week from today. Stock is selling just under $60 a share, and if it stays just where it is right now, we will make a little over $500, which is not quite. This is only about 6% of the portfolio value. This portfolio is currently worth about $7,200, and It's actually our best performing portfolio this year in 2015. It's made over 200% since the beginning of this calendar year. If you look at this risk profile graph, if Starbucks is anywhere between $60 and $63 1 week from today, with that 3-point range, this portfolio is going to gain 6% in 1 week. This is the ending of this short video on why I like calendar spreads. I will follow it up with another video on how to make adjustments if the stock price should move outside of the range, the break-even range. I do apologize for the roughness of this video, but this is the first time I've ever tried one of these things. I will improve it in the future. If you haven't already, go to sign up for our free newsletter. Go to the website careystips.com and get the free weekly newsletter with lots of free reports and lots of information about options. And that's all for now.